Hey, I'm Ben from Modern Graham, and today we are going to talk about Tesla. So be sure to stick around for my valuation of that company. So I've had a lot of people asking about Tesla and what I think of it. So we are going to do a quick review on it. It's probably going to be a little bit on the shorter side because there isn't much great to see. But anyway, the ticker, of course, is TSLA. The current price is 159.13. The sector is consumer cyclical, and the industry is vehicles and parts. Of course, Tesla makes electric cars, and it is famous for that. But anyway, these are the items on the balance sheet that are most important in the modern Graham valuation. We have total current assets, total current liabilities, long-term debt, total assets, intangible assets, total liabilities, and shares outstanding. And all of those numbers, which you see here, will come into play when we do the valuation. Over here, we have the chart showing the earnings and the dividends per share in red. Of course, there haven't been any dividends, spoiler alert there, but earnings, you can see they were negative for a very, very long time. And then all of a sudden, in 19, they turned a profit, and their profits have exploded, which is a thing that you want to see. You want to see profits going way up, but let's look at the detail. So we can see negative all the way until here when they have gone way up. We have the diluted earnings per share in this column, and this one is the earnings per share MG, which is a weighted average of the last 5 years of earnings, putting the most weight on the current year and the least weight on 5 years ago. Then over here we have the dividend data, but again, there's no dividend, so there's nothing to see there. Stage 1 is to determine if the company is suitable for the defensive investor or the enterprising investor. And the definitions for those, of course, are a defensive investor is not willing to do additional research into a company. They really just want to see if the company passes their tests, and then they can go farther from there. The enterprising investor is willing to do more research, and so they have less stringent requirements. The defensive investor, we have market cap of over 2 billion. We are way higher than that. Current ratio is under 2, so it fails that. It has not had positive earnings per share for 10 years or dividends, so it fails both of those. It has had growth in the earnings, so this actually, I need to revise this formula, but that would be a positive, or that would be a pass there. Earnings per share, price to earnings, PEMG, is 91.85, which is not below 20. So we fail that, and we fail the price to book ratio. So it is not suitable for defensive investor. Enterprising investors, it just barely fails the current ratio requirement. It passes the debt to net current assets requirement. So it gives a pass there. It has not had earnings stability. It fails that. It does not pay a dividend. It fails that. And again, the earnings here, it should actually get a pass there. But overall, it only scores 2 out of the 5, so it is not suitable for enterprising investors. If you are enjoying my content, please take a moment to like the video, subscribe to the channel for more, and of course, in the description and the comments below, there is a link to a free valuation calculator that you can use on your own to do more valuations. Stage 2 is to determine the intrinsic value. So what we want to do is we want to use Benjamin Graham's value formula from his book, The Intelligent Investor, which is what that Benjamin Graham taught Warren Buffett how to invest. And so his book about investing is a really good resource for people. And the formula he gave was value equals earnings per share times 8.5 plus 2 times the growth rate. I've updated it to have MG here, the modern Graham value formula, which just takes the weighted average of earnings, and that helps smooth out the business cycle. So we have 2 variables to calculate, earnings per share and growth. And earnings per share, we again take the 5 years and put the weight on the most recent. We get 1.73. To get the growth, we take that figure and the weighted average from 5 years ago, which is negative 0.47, and we calculate a total growth of 467% over those 5 years. Divided by 5, we get an average growth of 93%, and putting in a safety margin there. It's important that we don't overestimate growth because that can really mess up your value. And then we cap it at 15% because this is growth in perpetuity forever. Whoops, sorry for that noise. I hit the lamp next to me. I was so excited to say perpetuity. But the growth in perpetuity going forever. So I don't think it is possible for any company to grow more than 15% per year forever. So that is why we cap here, because again, you don't want to overestimate growth. It can really mess up your value estimate. So putting our variables in to the formula, we get a value of only $66.70. The current price is $159. So as you can see on my handy chart here, the current price is way more than the value, and it gets an overvalued rating. For the score, the Modern Graham grade, it is not suitable for defensive or enterprising investors. It is not undervalued, so it gets 0 points there. It is not trading below its Graham number. It does not pay dividends, so it gets 0 there. It does not pay dividends, so it gets 0. Its PEMG is not below its industry average, and it's not trading below its NCAV, so the total score is 0. This one gets an F grade, a fail grade on the Modern Graham grade system. Moving on, stage 3 would be further research, and we'll just take a look at a couple of things. The net current asset value, the floor in your value would be 78 cents. That's how much if the company took all of its current assets and paid off every single one of its total liabilities, and then the cash that it had left over, it paid out to every share. That's how much per share it would have. Graham number formula. The earnings per share, again, 3.97, and the book value per share comes to a Graham number of 33.58. This is another way of looking at those defensive investor requirements, and one way that people use to determine value. So let's go to the chart now. The chart is not looking great at the current moment. So we've been on, this is the daily view, by the way, we've been on a downward trend since September, and it did break above that trend line that was being established, but it came back down because we have this other resistance level that goes back to May of 21, March of 21, and it has kind of hovered around there a little bit, but it has continued to fall, and now it's back to pretty much following this trend line down. Then we have, going farther back, this is the older trend line that it was following, but then it broke down in the last few months, and coincidentally that coincides with about the time that Elon Musk was closing in on acquiring Twitter. So whether or not that had a connection there is up to you to decide. But for now, looking at the RSI, the relative strength index, this can show us the momentum in the company as well. And it has been down. There is not very good momentum in the stock. And it has gone below 30, which would indicate that it is in a bearish pattern. It did not really go under 30 for a long time before that. You have to go all the way back to March of 21, where it dipped below briefly, and then it was pretty flat for a while before coming back up. And then it was in a bullish pattern, although it was also kind of flat there. But now it is really not in a good sign. So I would be watching this one, but I would not be very excited about it. But anyway, that's it. I have given you your Tesla valuation. I hope you've enjoyed it. Click on the valuation or the video on the screen now to see another fun one. But thanks for watching, and I will catch you next time. Take care.